Well, greetings, my beloved clients and friends. Today's the day after Valentine's, February 15th. Just wanted to give you a market update, and I really want to answer this question. Have we seen the market bottom? And I believe the answer is yes. And I want to tell you why I believe that. So, where should I start? Let's talk about interest rates and the Fed. So the CPI came out earlier this week, and it was a little bit high, actually. So I don't think Powell's done raising rates, but I think he's done raising rates aggressively, like he did in the second half of last year. And we've seen a market rally since the first of the year, and really there were different parts of the market started rallying in October, and some things continued to decline through December. So it wasn't the entire market moving together, but so it didn't feel like a bottom or a rally, but I think it was, and I'll tell you why, and I'll tell you what I think created the bottom or took us to the bottom and got us above the bottom. So the three indices bottomed on October 13th. All three of them. That was their 52-week low on October 13th. The Dow, the NASDAQ, and the S&P. And they're up about 11 to 14% since then. Okay, but throughout the videos in the last half of the year, I was kind of saying that it felt like we had seen the bottom on June 13th, right? And so October 13th tested those June 13th lows, and it was actually about a little over 2% lower than those June 13th lows. Okay, so was June 13th the bottom? No, but I was only off by 2%, which is pretty good because, I mean, October 13th it tested that low. It actually surpassed it by 2%. And then within a day or two, it had made that back up, and we're back above the June 13th lows. Okay, so you could say that the stock market found the bottom on June 13th, and it stayed there till October 13th. And then since then it's been coming back. Okay, and so what do those endpoints signify? Well, June 13th was around the beginning of the 75 basis point rate hike era. There were 4 consecutive 75 basis point rate hikes, which started, I think, on June 12th, right around there, and ended around October 13th. Okay, so throughout that era, the market was at or near the bottom, with a few rallies in between. Okay, and so you could say the question on June 13th was, is it really this bad? And the answer was yes. Yes, it is really this bad. Inflation is really this bad. And yes, the Fed is really going to have to act aggressively. So the market just went to the bottom when they realized, you know what? This is real. Inflation is bad. It's real. I'm scared. I want to get out. So the market found the bottom. And there were still some people, well, maybe maybe it's done, maybe it's not. And then finally on October 13th, the question on the other end is this as bad as it's going to get? And the answer was yes. So those were the two questions that framed the bottom. You can say, is it really this bad, June 13th? Is this as bad as it's going to get, October 13th? And so those were the beginning and end of that market bottom. And so my clients are normally very resilient. They've been with me for many years, and through ups and downs, and net of all those ups and downs, we've made good gains, and they've grown to trust me, and they've become very resilient. And yet, towards the end of the year, some of them started to become weary and tired, and like, man, I'm tired of losing money. But the reality is that we lost money from November to June, and then we were just bouncing off the bottom. But it felt like we were still losing money because the pain of November to June was very real, and then the market would bounce off of that, and when the market went up, it wasn't really necessarily a good feeling. We've lost so much, and so what if it's up a little bit for a few days or weeks or whatever. It wasn't necessarily a good feeling because the pain from November to June was still real. It was more like just maybe a temporary relief from the pain, but then another down day, and it ignited the pain again. So even though June 13th was the bottom, we weren't losing any more money. You know, you'd gain some and then lose it back, gain some and lose it back, gain some and lose it back. It didn't feel good when you gained some, and it felt really bad when you lost it back again, right? So, but really, it bottomed out in June. That was the end of the terrible period of losses. The rest was volatility. Volatility feels like you're still losing, but you really weren't. You were just holding what was left as of June 13th. That's a hard sell and hard to explain. I know it, but that's the truth. I know because, you know, I get paid on assets under management, and my assets under management dropped from November to June significantly. And then they kind of just bounced off the bottom from there. They kind of flattened out because it's only a monthly snapshot, so it kind of takes a lot of the noise out of it. But yeah, so even going into October, November, it felt like you were still losing, even though you were kind of holding on to that. So, and I looked at every position in the portfolio, and I said, where was the 52-week low, and how much is it up since then? And it was very interesting in that a few companies bottomed out before October 13th. And those companies that bottomed out, it was usually company specific. Some big turnaround, some big negative news that took it around, and then a subsequent turnaround that caused the bottom. It wasn't really market related or macro related. But then on October 13th, first we saw the more Dow type names or value type names bottom out on October 13th. And then on November 3rd, we saw the big tech bottomed out. Microsoft, Facebook, Adobe, and one other one of the FANGs. It might have been Google. Yeah, so big tech bottomed on November 3rd. And And then around the end of December, between December 22nd and January 6th, that whole Christmas break, if you will, the rest of the stuff bottomed out. And those were a lot of companies that were down quite a bit. So they were victims of tax loss selling and window dressing. And once those tax loss selling was over, people started going back into them. And so from their various market bottoms, whether it was October 13th, November 3rd, end of December, or before that, those average of those companies are up from their bottoms 44%. So I would say, in hindsight, the buying opportunity was the fourth quarter of 2022. So did we miss the bottom? We're 1 to 3 months removed from the bottom. So we're still early. I think that's good. So you could say, Jonathan, were you late on calling the bottom? I think I was a little bit. I think I called it on June 13th, which was a good time, and even if I'm saying it now, there's not a lot of people saying it. I'm not taking my cue from someone else I listen to. I'm just looking at what I'm looking at and looking at the data. And I think history will show that fourth quarter 2022 was around that time was a pretty good entry point. So if we're in the first quarter 23, we're still pretty close to that entry point. So I think we're going to kind of change the tone a little bit on the portfolio, going from, say, conservative back to neutral, not aggressive. And so October 13th was also the peak of the 10-year interest rate when it shot up over 4%. And it's since come down below that. It was peak mortgage rates, and so it kind of has the signs of a bottom. And so if you look at the bond market, they're saying that they want long-term rates to be in that 3.5% to 4% range, which I think is a good range, a good healthy range. And yet, the short end of the curve, the one that Powell controls, he only controls the overnight rate, is almost 5%. So that's restrictive. When the short end is higher than the long run rate, it's restrictive. And I think it needs to be restrictive and sufficiently restrictive because of what's going on in the economy. And there's a lot going on in day to day in our personal lives, in the news cycle, and at home and work and family and politics and what have you. And sometimes we are focused on that and miss the big thing that's happening. And I'm going to tell you that we're in the midst of this amazing technological revolution. The way we live is changing dramatically, similar to what happened at the turn of the last century, where there are basically four guys that changed the world. And I'm talking about Thomas Edison with electricity, Alexander Graham Bell with the telephone, Henry Ford with the automobile, and the Wright brothers with the airplane. They changed the way we live, the way we communicate. That you could talk to someone instantly any place in the world with the telephone, and you had electricity. You didn't need to, firewood and stuff like that, and you had an automobile and you were mobile. You could, a day's journey went from 20 miles to hundreds, and it made the world much more smaller. You could talk to people anywhere on the phone. You could travel much greater distances with an automobile and an airplane. And you had electricity. You had a new source of energy. You didn't need windmills, or you didn't need to be by a river to have, those paddles or coal. So it just fundamentally changed things dramatically and radically, the way we live. And that's happening again. We're in the midst of that right now. And if you have said, I'm just going to invest in those four guys, Ma Bell, that was a great stock to own. General Electric, which was Thomas Edison's company, and Ford. Airplanes, not so much, because airplanes is kind of like the internet. It was something that's hard to make money off of, but it enables other people to make money. That's really what the internet does. And that's what the airplane was you could move goods and people and stuff around the world. They called the internet the information superhighway, and really you could call airplanes that too. Okay, but nobody made money off the internet. You say Al Gore invented it, he didn't become rich off of it. But people that applied it did become rich. Okay, so what's happening in our generation, there's just, again, a handful of guys that have changed the way we live fundamentally. And I would say, here they are. Bill Gates, Microsoft, Steve Jobs with Apple, Jeff Bezos with Amazon, the two guys at Google, Sergey Brin, I forgot the other guy's name, and Mark Zuckerberg at Facebook, and Elon Musk at Tesla. They're fundamentally changing the way we live, work, move, communicate, and play. And so those companies have been incredibly good investments. Just buy and hold for 20 years type of investments, and make a very, very plus 20% annual returns. Okay, because they're just fundamentally changing the way things we do. And then we had a decade of 0% interest rates, and that unleashed an unprecedented amount of capital into investing in growth and technology. Okay, that's over, but the ramifications are going to be felt for a long time. There are some the world is changing rapidly. Innovations in healthcare, innovations in technology, innovations in the way we work. Things like Zoom, that you could have a meeting any place in the world instantly. You could talk to people any place in the world instantly. And Steve Jobs put an iPhone in everybody's hand globally. And even in the third world, people that live in huts have cell phones, and they could conduct business, and they could buy stuff, and they could sell stuff, and they could communicate, and everything now is in the air. Your friends are in the air in Facebook. Your shopping center is in the air with Amazon. Your energy is in the air with solar, and Elon Musk is trying to harness that. And your relationships, and you could work and move, and there are no physical barriers, and so we really got to look forward and say, where are the opportunities? Because there are opportunities that are immense for a handful of companies and individuals that will take advantage of this major change that is happening right now. There's this thing right now called ChatGPT that Microsoft just invested another $10 billion into it, that they had already invested a sizable amount. and it's fundamentally changing the way we process information. And I mean, just think about, you could just ask a question to the air and you'll get an answer. That's what Google is. Google is all the knowledge of mankind at your fingertips instantly, and it goes through your Apple iPhone. Those are huge changes, and the applications of those things are just beginning, and acceleration is accelerating. It's just it's you can't downplay it. You can't upplay it enough, really. And so the investment opportunities are massive, and there will be hiccups on a day-to-day basis. And if you really focus in on how you feel today, and you're gonna miss the opportunity. You're gonna get lost, and this doesn't happen all the time. It happened at the turn of the century with those other four that I mentioned, and then for a century, the applications of those things were enabling growth and development, and then now here's another massive breakthrough, and it's going to take as we apply these things, it's going to develop over decades. So I don't want to understate the opportunity that is before us. Obviously, there are risks in the short term, and not every company is going to be a winner, and so it's challenging to sift through all the opportunities and find the ones that are winners. But the change that is happening, just think about the way you used to do things and the way you do things now. At our office, when we have an idea, sometimes I ask child, hey, ask your kids what you think about this company, and I'll ask my kids. And I don't want you to give the impression that Charles' kids and my kids are running the portfolio. But let's be honest, in our 50s, Charles and I are not bastions of cultural relevance. So the hard work we do, but that small piece that isn't culturally relevant, we don't ask ourselves, we ask a more qualified generation. Because the change is happening so fast that we can't keep up with it. The young people are keeping up with the change a lot faster than we are. So we want to hear from the younger generation, right? I mean, there's a lot of things that they come out. I have to ask my kids, hey, how do I do this, right? And even my kids are now in their mid-20s, and on some things I have to ask my grandkid, hey, how do I do this? Because that's how fast things are changing, and the kids are in touch with that. So I'll give you an example. So Joe Biden did his State of the Union, and he's on this big pitch about, we got to bring back manufacturing. We got to bring back good, high-paying manufacturing jobs. And that's really a thing of the past. In the 50s, in his dad's era, there was good, high-paying manufacturing jobs, but you have to understand why. There were good, high-paying manufacturing jobs in the 50s because the world had just gone through a war, and the world had been destroyed and needed to be rebuilt. And the young men that needed to do it, a lot of them died in the war. So the monumental task of rebuilding the world was left to the remaining men that didn't die in the war. So those men that remained, they're often called the greatest generation, but I think they could also be called the luckiest generation. were assigned to rebuild the world, and they needed anybody. Anybody could get a good, high-paying manufacturing job because there was a lot of them, a lot of jobs, and not a lot of people because the war had killed a lot of people. And so not only did they have a good, high-paying job, a lot of them had a GI Bill so they could buy a house, which they never fathomed. The GI Bill said they could go to college, which they had never fathomed. Even if they were a 4 or 5, they could probably marry an 8 or a 9 because there was a shortage of men, right? And the market for wives had been globalized, right? They had seen the world, and they didn't. The market for wives was not just their town. They could find one in England or France or Germany or Italy or Guam or Japan, right? And they did, and these guys married way above their weight class, right? Not their weight class, but I don't want to infer. They married way above their range, right? And they got jobs way above their skill level, and they were able to buy house. And then, technology was giving them things really cheap that their parents didn't have, like toasters and indoor plumbing and refrigerators and washing machines and a car and a garage and paved roads and motels and vacations and you know what I mean? So they felt like the greatest, luckiest generation. They were probably the luckiest generation in the world. That with a guy that maybe didn't even graduate from high school could have a really decent life. But it was because the stars aligned in that one instant that the world had a massive need and there was not a lot of people. And they happened to be there in the right place at the right time. So to try to say, let's bring back good, high-paying manufacturing jobs, those are not the stars that are aligned anymore. Now manufacturing jobs are not high-paying. It's not normally high-paying to work in a factory, right? Those high-paying manufacturing jobs are now done by computers and robots and machines, and the Chinese or Mexicans or Vietnamese for a very low cost. So to try to bring those back to America, I know it sounds good and people want to do it, and it gets votes, but I'm not sure it's the best idea. It's like I'm gonna say, I'm gonna go back to playing basketball, because in 6th grade I was good at basketball. Before when me and all my friends were the same height before they had the growth spurt and I didn't, and I was only playing against the kids in my neighborhood. But now that I'm my age, I should say I'm gonna go back to being a great basketball player. 1, I'm old. 2, I'm short. 3, now the basketball players come from around the world, not just around my neighborhood. That's kind of like what America trying to compete in manufacturing is like. We should look at what our skills are and do that, and look at towards the future, not towards the past. Like where are the opportunities going forward, not where were the opportunities 50 years ago. So, we want to be forward looking when we manage your portfolio. We want to be aware of the opportunities, and to do that often we have to take a step back and go up 10,000 to 15,000 feet and survey the landscape and say, this was in the news today, or this was in somebody's speech today, and not be moved so much by that kind of stuff, and more be influenced by what are these macro trends that can endure for a decade, that we could identify a company that is uniquely positioned to benefit from that, and has a sustainable moat and solid financials and good leadership, and that's going to get us through the day-to-day bumps. And it could feel like we keep losing money, but we're actually making money off of those June lows. We're well above them now, and I think the worst is past us. Am I 100% sure? No. But I'm probably about 75 to 80% sure that the worst is past us. So I hope that's encouraging. I know I went a little bit long. Had a lot to say. I guess and now I've run out of trails, so I'm going to go ahead and end the video. And I hope you guys have a wonderful day.